How'd you come to this framework of a variable dividend and the growth forecast that you're looking at?
Yeah, thank you, Alix. As you know, we probably have one of the best balance sheets in the industry, and we have one of the best rocks or inventories of the industry, and that allows us to start the growth framework earlier than most companies. Too many companies have too much leverage. They're going to have to delever for 2 or 3 years. So we're actually starting growth rate of 5% in 2021, as long as Brent is at 45 or higher. Today, Brent's next year is at over $48. So it's, with the excitement about vaccines coming in the news, the oil strip continues to move up. Our framework started in talking with some of our large investors over a year ago about what's the best mechanism if we're going to lower our growth rate from the mid-teens down to a lower number, and we have significant excess cash flow. What's our best framework? And they all mentioned the variable dividend. Other industries are doing it, but we're a very cyclical commodity business. And so we have a strong base dividend of 5% plus production growth. And then the rest of our excess cash flow will be dispersed in regard to a variable dividend. The board is evaluating this policy. Will come out next February to be more exact on the mechanics. It'll be paid probably in arrears, probably a year late on a quarterly basis, most likely in the year 22. But we're showing excess cash flow, significant numbers over the next several years with the Brent oil strip. Right now, the Brent oil strip is about $50.
Yeah,
so we think that'll be the main mechanism to distribute returns to the shareholders.
So I'm wondering, Scott, I mean, if that $50 goes up to 60 or 70, do you change your growth target? Do you change the dividend, or do you just like pocket it and sit on some cash?
No, with our leverage already in great shape, we will disperse most of that as a variable dividend. If oil goes to 60, if oil goes to 70, if oil goes to 80, it'll be significant payouts to our shareholders on top of the growth rate of 5% plus, on top of the 2% base. So we could be having a 4, 5, 6, 7% type dividend on top of those first two numbers as a variable dividend.
Oh, interesting. Okay. In terms of your actual production growth, some of your peers have been bringing oil production back, but pretty conservatively. If you look at, say, Conoco, Chevron, or Exxon, how conservative are you in bringing back the wells that you originally shut?
Yes, Alix, we only had 7,000 barrels a day shut in. And they were all vertical wells, very high operating expense. We only brought back about 1,000 barrels a day, so insignificant. So we never had the issues. We had takeaway capacity all the way to the Gulf Coast. We've been exporting most of our crude over the last 3 to 4 months during these tough times. And so we've had no issues of major shut-ins like a lot of our competitors.
Does that oil that you didn't bring back, does it ever come back, or is it gone for good?
I would say at $50 or higher, we'll bring half of it back, and half of it will probably be gone for good.
In the industry, we've seen a ton of bankruptcies. Is it over, or where are we in the wave of bankruptcies?
It all depends on what happens to the oil price deck and also their ability to go out to the debt market. So there's over $40 billion coming due in the next 2 years. But most of these independents, they have to refinance that debt. They don't want to refinance at 8 to 10% interest rates. And so the key is oil price deck, whether or not they can sell assets. So I would expect that we'll see several more coming over the next 6 months, and then it'll slow down going to 2021.
So in 6 months, Scott, are you dusting off your cash bin to buy something?
No, we have a great inventory, Alix, and that's where we're focused right now. So.
Clearly, in terms of your acres, I mean, your acreage for a shale player, you want it all together so you can drill deep and then you can drill out, and you have that. But at some point, some of these assets have got to be so cheap, especially if they go through Chapter 11, that you can't help but buy. Also, you got to compete with the EOGs of the world, too. What's your thinking behind that?
Yeah, I mean, you got to realize we're slowing our growth rate down from 15% down to 5%. So our inventory is actually lengthening. So I got the question on earnings call, what are you going to do with your excess inventory? And obviously, if the cash market ever comes back, we may sell some tier 2 acreage. But right now, the private equity market's dead. Nobody has cash, so we can't really sell any excess acreage. We are doing trades. We have a great land group, and we're doing trades. We're adding significant trades with other Midland Basin operators as we speak. And the key to that is taking a 5,000-foot section and going out to 10, 11, 12,000 feet and picking up that additional acreage.
They're really interesting. Scott, I started the interview talking about BP, the CEO I interviewed earlier today as well, and their net carbon emission strategy. Vice President Biden, his energy plan, if he gets elected, is in 2050, they have a target for achieving net zero emissions across the U.S. How do you think about the political world right now in your shoes?
We're fortunate enough to be in the Permian Basin. We're fortunate enough not to have federal lands. We're also fortunate enough, all of our pipelines go to the Gulf Coast. They're all intrastate. And so if Biden is elected, I'm sure he'll unwind some of Trump's energy actions that he's taking. We'll see slower pipelines. We may see ban on federal lands, on fracking. But I see no effect on us. Now, we've led the flaring discussion in the Permian Basin over the last 18 months, which has been very, very important for the industry. We continue to be the lowest flaring intensity flare in the Permian Basin. We think still more action needs to be taken there. I see significant improvements, and so that's where we're focused going forward.